everyone. Today we have come up with another topic, which is our session number 97, how to analyze banking stocks. So this topic has been long demanded by the subscribers and the group members. So I have come up with this detailed analysis. So here we will be going through what the bank business is like and how a bank does the business, how he creates profitability for the firm, and what are the valuation matrices which is required to analyze the banking stocks. So the banking stocks can be of HDFC Bank, ICICI Bank, South Indian Bank, Federal Bank, etc. So in session number 97, which is this session, I'll be going through the entire parameters which has to be analyzed as far as the banking stock is concerned, unlike a typical stock which is like a manufacturing related stock or a FMCG kind of stock. So the parameters which is utilized for analyzing a banking stock is completely different. So that is why I have come up with this video. And in session number 98, which is the next session, we will be analyzing maybe two banks, maybe HDFC Bank and South Indian Bank, which is like a large capital bank and a small cap bank, wherein we will be applying all these valuation matrices or the parameters which we have discussed in this video in a practical way, so that you can evaluate how practically the parameters can be applied on the banking stocks and how to choose a banking stock for you to invest. So once this session is done, I'm sure that you can independently look at the parameters and evaluate and analyze the banking stocks and take a correct pick for you to invest. So let's get directly into the topic. So understanding the banking business, a quick glance. So if you see, banking model is simply the process of connecting borrowers with the lenders. So banks take deposit from savers and lend these funds to borrowers as loans. So if you see, banks are like forerunner to the economy. So if the economy has to grow, then definitely there should be lending activity, so that a lending is done, a borrowing is done by the borrower, and then happens a credit. So fractional reserve banking, this is a topic which I have already covered in session number 71. If you have not seen that, I strongly recommend you to go and watch that video as well. So unlike gold standard, fractional reserve banking is a system where banks only keeps a portion of their customers' deposit in reserve, rest all is lent out. The reserve to be retained is imposed by the central bank of the country. So in case of India, it is Reserve Bank of India, RBI, wherein they tell that a particular portion of the deposits which they have received from various depositors has to be kept with uh, them and with the bank, so that they have some adequate risk mitigation in place, so that if something happens to the bank, then the recovery can be done. So if you see, it's all about managing the books efficiently. That is the banking business. So the books can be loan book and investment book. So if you see, for all the banks, the macroeconomic conditions like the inflation rate, the rate of interest and liquidity, all are almost the same. So what differentiate one bank from the other? So it's how efficiently the funds, that is the deposits which they get from various retail investors or institutions, or the assets, which is the loans. So for a bank, what you get as asset is just the loans, like what you lend it out, that is generating income, continuous income for them. So those are the assets. So how efficiently the funds, which is the deposits, and the assets, which is the loans, are utilized, and how best the spread are managed. So what is a spread? So bank spread is like the net income rate spread. So in other terms, so to state an example, for to know what is spread, say HDFC Bank. So it has got a interest bearing liability, like they have got deposits from various depositors, and they are giving an interest of say 2%. It's a liability for them, and they have given out the loan say at a interest rate of 6%. So that's like a asset for them, because 6% interest rate they are getting an interest payment month on month. So they are it's a cash flow for them, so it's a asset, wherein the liability, it's a deposit, so they have to pay out the interest to the depositors. So what is a bank spread in that case? In that case, 6%, which is the interest rate they are getting for the loans lend out, and 2%, which is the interest rate which they are paying to the depositors. So 6 minus 2, 4%. So that 4% is the spread. So loans. So loans, as I told, is assets for the bank, and deposits is simply the liability for a bank. So again, what I explained here, understanding banking business. Although banks do many things, their primary role is to take in funds called deposits from those with money, paying them a lower rate of interest, obviously, and pool them and then lend them to those who needs funds at a higher rate of interest. So the example of HDFC, simply it was an example wherein deposits they are giving at 2% interest, and say the lending they are doing at average 6%. So 6 minus 2 gives you the spread of 4. So RI is written as rate of interest. So you can see the deposits here, depositor here, that borrower here, the bank takes the deposits, pays an interest. Similarly, gives out the loan, takes an interest. So banks are like intermediaries between depositors who lend money to the bank and borrowers whom the bank lends the money. So that's simply the bank business looks like. So bank, a financial institution licensed to receive deposits and make loans. Banks may provide financial services such as wealth management, currency exchange, safe deposits, etc. So deposits and loan, the spread between those is the main income for the bank. And also, as I told, there are other financial services like wealth management, your mutual fund uh, commissions, then currency exchange, then the gold deposits or the valuable deposits. They take the safe deposit boxes, so they earn a commission or the charges on that yearly. So those are other instruments, or even they have got insurance business, and many banks are having a separate insurance business, but still they get commission for selling those insurance to the regular customers of the bank. So that is another source of income. But still, the main source of income is from the deposits they take and giving out the loans, various loans. It can be various types of loans as well. So this is like a bank. Then checks, letter of credit, debit card, credit card, vouchers, demand draft. These are all the various uh, ways by which the bank operate. So reasons of banks like HDFC or Kotak is enjoying higher price to book value is not only undervaluation or overvaluation at all. So price to book value allows banks to be classified based on the efficiency of the use of funds. Hence, price to book is more important for banks and financial institutions. Now, what is price to book ratio? How to derive that? What are the parameters by which you understand the bank is operating efficiently? Everything will be discussed in the coming slides. So now let's get directly into the slide wherein we understand what are the parameters required to analyze the banking stocks, or the factors for evaluating the banking stocks. So the first one is deposit growth, which is deposit growth year on year, you can say. So deposits are the major sources of funds for the banks. So the banks accept deposits as term deposits, FD, RD, then savings account, current accounts, etc. So these are like the various ways by which the banks takes the deposits, and these deposits are like liability to the bank because they have to pay an interest rate on that, unlike a current account wherein current account has zero interest rate. Otherwise the other types of savings account and fixed FD or RD has got various interest rates to be paid out. So these are like liabilities, and the current account is like it's good because they can keep the money with the bank as deposits which are without giving out any interest rate. And in case of loans, it's like an asset because they are giving out loans from the deposits which they have received at a lower interest rate, or else at a zero interest rate in case of an current account, and then giving out the loans to the borrowers at a higher interest rate. So we already discussed about the spread, which is the difference between the higher interest rate loan amount, interest on the loan amount, minus the interest paid out for the various deposits. So now that you have understood about deposit and deposit growth, next is advances growth. So advances growth as percentage. So advances is like loans given out to the customers, and hence considered as assets in the business as far as banks are concerned. And rise in advances and its rates depicts how the bank is growing its business. So based on various business tactics or marketing activities or efforts by the bank or strategies by the bank or the banking management, the advances growth has to be increased so that the loans given out are at the highest, so that they get the highest return. Then comes the loan book growth, which is like year on year. So loan book growth also has to increase year on year, so that you get, as I mentioned, in advances growth, you need to get higher amount of loan book growth, so that you get more interest income from the borrowers, so that the bank's revenue increases. Then next comes the investment book. So investments can be like, they have got various investments. They may invest in various mutual funds. They may invest in various companies as well, like subsidiary companies, or various other stocks, so that this also becomes like a uh, continuous cash flow generating investments. So this is also important. Then comes the cost to income ratio, CIR. So this is like lower the better. So what is a cost to income ratio? So it measures how efficiently a bank manages its cost relative to its income. So it's simply the ratio of bank's operating expenses to the bank's operating income. So the income increases, operating income increases, which is in the denominator. The cost to income ratio decreases. Also, if the bank's operating expenses increases, then the cost to income ratio increases. So it is always better that the operating income is increased, the operating expense is reduced, so that the ratio is less. So cost to income ratio has to be lesser, so that it shows the bank is operating at a higher efficiency and better profitability. Next comes the net interest income, which is very important, NII. So what is net interest income? So it is the difference between the interest earned minus the interest expended. I repeat, it is the difference between the interest earned minus the interest expended for the deposits, obviously. We already discussed earlier what is a spread. So it's a difference, percentage difference between the two, which is like the interest earned minus the percentage of interest expended. So that's spread. And the amount in crore, say crore, that is like net interest income. So the interest earned from various loans given out minus the interest expended for the various deposits taken in, that thing is the net interest income. So obviously the net interest income has to go up, so that the bank become profitable. Next comes the something related to net interest income only, which is the net interest margin. So this is simply the ratio of the net interest income, which is like the interest earned minus the interest expended, divided by the interest bearing assets. So it's like NII divided by the interest bearing assets into 100%. So this shows how profitably the bank is operating. So it is basically the measure of profitability levels of a bank's lending and deposit operations. So basically the main activity of the bank, which is lending and deposit operations. So how efficiently that operates, that ratio is the net interest margin, which is expressed in percentage. So again, net interest income divided by the interest bearing assets into 100 will give the percentage of net interest margin. Then comes the PAT, profit after tax. So it is basically otherwise called net profit. So obviously, like other businesses, this banking stocks also has got a PAT, and the PAT has to be growing year on year, at least at 10 to 12% growth rate. So that, which shows that the banking revenue is increasing, and also the profitability is also increasing in similar ratios. Profitability of the bank is maintained year on year, and it is growing year on year. So this is one important parameter, like what we discussed for other stocks as well, which we have done in earlier sessions. Another important factor is capital adequacy ratio. So this has to be more than 12-15%. Anything below 12% is considered to be a bad as far as capital adequacy ratio is concerned. So obviously higher the capital adequacy ratio, the better it is. And similarly, in case of net interest income, net interest margin also, higher it is, the better it is, because it shows how profitable the or how efficient the bank is able to give out loans at a higher interest rate compared to a lower interest being paid out for the deposits. Coming back to capital adequacy ratio, so capital adequacy ratio is nothing but the ratio of capital which the bank is having. So it is obviously the deposits which the bank is having to the risk weighted assets. So what is risk weighted assets? So weighted assets can include fund based assets like cash, loans, investments, and other assets. So that's the risk weighted assets. And capital, already we told, it's all the deposits which So capital can be again of tier 1 capital and tier 2 capital. So tier 1 capital includes funds in hand to manage the losses, and tier 2 capital includes funds from the sale of assets once the bank loses its charm. So it's like if the bank is to be sold, and if it is sold, whatever the amount we get, that's kind of tier 2 capital. And tier 1 capital includes like mainly it's like shareholders equity, retained earnings, etc., which is readily available in the bank. So if you see the capital adequacy ratio to be maintained by a particular commercial bank set by our Reserve Bank of India RBI is 9%, and for a PSU bank it's like 12%. So that's the minimum capital adequacy ratio to be maintained. So that's why I told that 12% means it's like the lowest. So it has to be much above to show the healthiness of the banking system. So it's decided basically this capital adequacy ratio, it's decided by the central bank, in our case in India it's RBI, to prevent commercial banks from taking excessive leverages. So that's why this capital adequacy ratio is to be maintained by the banks. Now getting to the asset quality, which is vital for a banking system. So this can be split into two: gross NPA and net NPA. So what is NPA? This I have discussed in detail in my much earlier sessions. So NPA is nothing but non-performing assets. So gross NPA is like the ratio of gross non-performing assets to the gross advances. And say what is an NPA? It is simply nothing but if interest is not received for 3 months from the borrower, then that particular account is considered as an NPA, because he is unable to pay the interest or pay back the interest. So this means that he is having a quality concern, and he is declared as particular borrower is declared to have an NPA, net non-performing assets. So net NPA is nothing but the gross NPA minus the total provisions held. So what are provisions? We'll get to know about that in the coming slides. So basically, a high gross NPA or net NPA shows that sizable portions of the loans given out are not generating income because they are not able to pay back the interest on time, and hence causing high levels of risk. So because if it is only lending and no interest is coming back, then there is no what like the business is like not generating any profit, and it is only making the borrower rich or whatever you say. Also note that gross NPA is always higher than net NPA, because as I told, gross NPA minus the net total provisions gives you the net NPA. So that is why we have to look at various banks wherein strategically they have to go with good customers who is borrowing, so that we have to ensure that the uh, interests are paid on time. So that is why the mix of retail versus corporate lending has to be seen. So in retail, if you see, it's a granular type of loans. Like there are 10 retail people like me, another guy, so another guy. So like that, they are splitting the loan into 10 people. So I take 10 lakh, another person take 10 lakh. Like that, if 10 people are taking, 1 crore is given by 10 people. So if I also default, say 10 lakh defaults, still they have got 90 lakhs income from other 9 people. But in case of a corporate lending, like ICICI Bank is having a high ratio of corporate lending, unlike HDFC Bank, wherein the retail lending is more. So if you see the ICICI Bank, say he is lending to Vijay Mallya, he is a single entity, and the lending amount is also very high. So they charge higher percentage, but still the lending amount is very high. So if it goes correct, then the bank will make money. But if goes default, like which he has, so in that case, the entire amount, it being non-granular, because everything funds is in case of corporate loans, it is going to a single person. So that going wrong means the bank's complete loan book is at a stake. So such is the importance of non-performing assets or NPA. So it's bank's efficiency we have to look at, and how the bank has uh, gone ahead with creating a lesser NPA and improvising the loan book. So if you see, PSUs were also having high amounts of NPA, but after the new government came in, the PSUs have strongly uh, grown their loan book, and they have reduced their NPA to a very high extent. And that is why if the NPA is low, also the provisions to be kept against that, because if the loan goes wrong, then some provisions has to be there. So that's what is called the provisions. So if the provisions are low, then that much amount can be utilized for giving out the loan to other people, again allowing the banks to get more income, because there is no provisions, so provisions doesn't fetch you any interest rate. But if the provisions are low, then that amount can be utilized for giving out as loan, and then getting higher returns or higher interest income, thus improving the net interest margin. Now the next ratio is provision coverage ratio, PCR. So it's the ratio of total provision balances of the bank to the gross NPAs. So PCR, which is the provision coverage ratio, indicates the extent to which the bank has provided for the weaker part of its loan portfolios. So provision, because as I told, if the bank expects the particular loan to go as an NPA, then they have to give out, or they have to consider higher provisions, which is actually not good for the bank, because they are taking a risky shot there. That I understand, that we should understand. But again, if that risky thing goes wrong, then the bank will lose that deposit, or bank will lose that loan which is given out, and also the provisions which they have to keep, which was again not generating any income for the bank. So on the both sides, higher NPA and is also a difficult thing which is not allowing the bank to generate profit. So if you see, a higher PCR percentage is considered to be good for the bank, because uh, means what is considered healthy is above 70% PCR ratio. This is because it shows that the bank has covered all its NPA with good provisions, and if it is more than 70%, it shows that if at all something goes wrong to the uh, NPA, or if something goes wrong with the particular borrower, and if it goes as NPA, then the provisions are in place to cover that issue. So that is why if the PCR ratio is higher, it is considered to be good, because the bank has taken care, already taken care of the NPAs. Now getting into the next important topic, which is CASA ratio. So CASA ratio is current account savings account ratio. So what is that? So as I told, the current account has got no interest to be paid out for the deposits taken by the bank from the depositors, and for a savings account, obviously he has to pay out interest. So it includes your FD also, normal savings account also, the RD also, then other deposits. So the ratio of the current account to the savings account uh, is that obviously if the bank is getting more current accounts, so his cost of capital is very less, because it's like zero interest they have to pay out. But in a savings account, they need to pay 2 to 4% or higher interest rate. So if a high CASA ratio is there, then the lower cost of funds will be there for the banks, because uh, as I told, deposit is a liability to the bank, and if they are getting free money, which is like current account, then they are getting uh, more deposits at cheaper rates, and these deposits are again lended out to various borrowers at a higher interest rate. Like they can lend a home loan at 8.7%, 8.2 to 8.7% as I currently speak, and they can give a commercial loan at 10%, they can give a personal loan at 13%, and even various things they can give it at a very much higher rates compared to the cheap or nil interest rate which they have to pay for a current account. So higher the CASA ratio, better it is. So every bank will try to keep a high CASA ratio, but for that CASA ratio to come in, the bank has to have a good reputation, so that the various depositors will trust the bank and put their money into the bank. So you can see that various new companies or new banks like IDFC First and all, they were earlier struggling for a to get a higher CASA ratio, and they were giving out higher interest rate for the savings account also, so that they get customers. Once they get customers, they start generating revenue. Then the customers starts trusting them. Then they start reducing the savings account interest rate. And also once the customer starts trusting them, then the current accounts also starts increasing, which will increase the profitability of the business of that bank. Now getting into the next thing, which is loan to deposit ratio, LDR, otherwise called credit to deposit ratio. So basically this LDR measures the bank's liquidity. So it has to be, this value has to be optimum. So this is like bank's total loans to the total deposits. So if this value is higher, it shows that there is a liquidity crunch, and lower means underutilization of the funds. So this value has to be somewhere in between, so that they optimally manage the funds, so that there is no liquidity crunch or there is no underutilization of the funds and it is optimally managed. So that is a skill of the banker. Next is cost of liabilities. So cost of liabilities is like the interest income which the bank needs to pay. If the cost of liability, the value is lesser, then it is the better. So if the interest income the banks needs to pay is much higher than what he is getting from lending the deposits, then it is very difficult for the bank to sustain or establish. So that is why the cost of liabilities has to be the lowest. Next, coming into segmental revenue. So segmental revenue, it is again like what are the revenues, like it can be treasury bills. So this is like the bank has to keep some uh, amount with the RBI. So they will have to invest in treasury bills, etc. So the income from them. Then the retail banking. So as I told, the retail people we can lend to them. So the retail banking. Then the third party products. So third party products is like your mutual funds, insurance, forex, other businesses with commission. Next is the customer profile, retail versus wholesale. So retail versus wholesale business mix has to be proper. So as I told earlier, the corporate loans are riskier than retail loans because retail loans probably is in granular form and it can risk is mitigated among various investors or various borrowers. But if you see corporate loans, it is chunk of loans, higher rates given to big institutions. So if the institution or the business goes wrong, then the NPA comes to that loan. So the customer profile or the retail versus wholesale business corporate versus retail mix also has to be optimal so that the bank generates enough profit. Now next is the geographical mix. So urban versus semi-urban versus rural is something which we are looking at. So the key driver for future growth is supposed to be rural. So there also we have got tier 2, tier 3, etc. So the government boost by government for the rural uh, mob is actually uh, something which the banks are concentrating on these days, and this will lead to more business by the banks if they are concentrating on tier 2 tier 3 sectors from the rural sector. Next comes the competition with PSU. So national banks like SBI, PNB, etc. is there. So also government is bringing in various schemes or uh, strategies by which these banks are becoming more profitable, reducing their MPA, generating more profit. So this is again hitting the profitability of private banks. So it's like the if the public banks or the PSU is able to satisfy the customers, and if they are becoming more privatized, like in the sense the way of working becomes more private like more sincere and more customer friendly, then the people who are investor or people who are depositors in the private bank can move to PSUs, which will reduce the CASA ratio of the banks, private banks and commercial banks, and then it will impact their profitability. Now next comes the price to book ratio. So we have discussed that earlier as well. Banking is all about managing the books, like we told, the loan book or the investment book efficiently. So price to book, if it is lower, don't consider that it's a undervalued system, because if the price to book is low, then probably the uh, profitability or the efficiency of the banking system is also lower. That is why somebody has not valued it, and hence the price is low. That's why the price to book value is less. But ideally, if you see, a healthy price to book ratio can also be accepted, unlike the other businesses which we value. So that's how the price to book value works for a banking stock. Then comes the ROA, the return on assets expressed in percentage, which shows how profitable a bank's assets is generating revenue, how efficiently the bank is utilizing its assets, which is the loans, to generate profit. So minimum 1% or 1% and above is expected as far as the ROA percentage of a banking system is concerned. Now that we have discussed about price to book and ROA, let's discuss about ROE. So ROE, like we discussed for other stocks also, it is just the ratio of net profit to the net worth. So net worth is nothing but the capital plus reserves and surplus. So that's the net worth, and net profit is obviously the PAT the company has generated, the profit the company has generated. So this higher the ratio, the better it is. Something higher than 12 to 15% is considered as a healthy ROE. Again, it is relative. So for a particular period, you have to compare the various banking systems or the banking stocks and what is their ROE. So that has to be seen, and relative valuation has to be done as far as the ROE is concerned. Now, other factors to consider is like the peers. So peers is like the various banking stocks, what are the market capitalization and what is their peer, how is the profitability. So these things has to be checked. Then economic slowdown, this is something which has to be seen. So there can be various measures taken by the central bank, in our case RBI. They may increase the repo rate. So they increase the repo rate, looking at if there is a higher inflation, they increase the interest rate, so that they can bring down the inflation. The buying power can be brought down, so because they are borrowing, interest rate increases, because once they increase the repo rate, the banks will have to increase their interest rate at which they are lending. So because the repo rate is the rate at which they are getting the funds from the central bank. So this increase in interest rate will affect the demand and supply. So if the interest rate is increased, then the cost of borrowing also increases. So profit margin also is impacted in such a case. So economic, monetary policy is also important in case of a banking stock. And other is like impact of regulators. Again, RBI has got various things like CRR, the cash reserve ratio. So currently the cash reserve ratio is as I speak on, as on August 2023, it is 4.5%. The statutory liquidity ratio, which is SLR, is around 18%. And so the total funds is like 4.5 plus 18%, which is like 22.5%. So 22.5% is not to be touched only, in the sense, if you are getting 100 crores from the depositors as deposit, out of that 22.5 crore will be kept as CRR and SLR, and it cannot be touched, and rest only can be given out to the lenders as loans. So repo rates really affects the bank's business. Another thing is that you really have to look at the investor presentation and the annual reports and the financial results quarter on quarter, released by the particular bank. Say if in case of HDFC Bank, you have to go to the investor relationship of the HDFC Bank and see what all things has been mentioned by them, especially in the investor presentation, wherein they will be telling the year on year or the quarter on quarter reforms, or the margins, or the improvement in things which they have achieved. So this has to be evaluated before getting into the particular, or before buying a particular banking stock. So the capital adequacy ratio can be increased by having a lower NPA and more deposits. And more deposits in the sense, if they are able to maintain more CASA, then more CASA means more capital. So more capital means the capital adequacy ratio increases. So again, if capital adequacy ratio is increased, then the advance growth rate also is more. So the loan given out is also more. So lower NPA means more revenue also generated from that loan given out. This will result in more, higher ROE, higher ROA, and higher earnings per share, which will increase the bank's profitability. So this is all about the, if you connect all the figures together, so then this also means that you are having a higher net interest margin, because you are having a higher net interest income. So hence you are having a net interest margin also. You are having a low cost to income ratio. You have a good investment book. Your loan book growth rate is also high, and your deposit growth is also high, maintaining a higher CASA ratio. Hence your PAT also is higher, because you are having a good asset quality with lower NPA. So the provision coverage ratio is also kept healthy, so that you take care of your NPAs. And also, as I told, CASA ratio has to be kept high. The loans to deposit ratio also has to be optimally positioned, so that you are not having a liquidity crunch, or you are not underutilizing your funds. And also the cost of liabilities has to be kept less. You should have a good segmental revenue. A good customer portfolio has to be kept. A good geographical mix has to be maintained. Competition with PSU also has to be checked by having strategic lending and maintaining a lower NPA as well. We all discussed about these ratios. So this is like the factors to be considered while analyzing a banking stock. So on the screen, I have just tried to capture some few points which we have discussed in our slide. So if you see, we are having a total, say we are getting a deposits of say 100 crore from the depositors by banks, various marketing activities, and brand value. And then investments, say accumulated over a period is like it is 50 crore. So this is only an example, so that is why I have given a very low value. This is in huge crores, but I have taken a smaller value for you to understand. So assumed rate of interest on investments, say it is 8%. So investments can be in various stocks, mutual fund, etc. So year on year, say we get 8% return. Then the RBI repo rate is, say currently it is at 6.5%. So according to Reserve Bank of India, the bank should not borrow more than 100% of their capital funds on average over a fortnight. However, banks can borrow up to 125% of their capital funds on one day during a fortnight. When there is a shortage of funds, then the commercial banks borrow money from the central bank, which is repaid according to the repo rate applicable. So that's what is repo rate. The central bank provides those short-term loans against securities such as treasury bills or government bonds. The Reserve Bank gives money to banks through a process called repurchase agreements or repos. So hence the repo rate. Now the marginal standing facility, which is MSF rate, is at 6.75%. So this is the interest rate at which the Reserve Bank of India provides money to the scheduled commercial banks like HDFC Bank, who are facing acute shortage of liquidity. So if they don't have money, then they can take the loan from they can get the money from the central bank at an interest rate of 6.75%. And this rate differs from the repo rate, and the banks can get overnight funds from the RBI by paying the exclusive MSF rate. So that is why the interest rate is slightly higher, because they can get it immediately overnight, unlike this repo rate. And also NPA is, say, it is at 0.3%. So SLR, we already discussed, can be invested in RBI statutory liquidity ratio. SLR can be invested in RBI mentioned government bonds, gold reserve, invest in PSUs or approved securities. So this is at 18%. So this 18% out of the deposits of 100 crore, 18%, which is like 18 crore, is never invested or never given out as loan, but to be invested in these bonds. Then there is something called high quality liquid assets, HQLA, that is again 5% around. Then average returns from SLR fund investments, say it is 5%. Then the average return from HQLA funds also, that is considered as 5%. So assumed as average gold bond yield with 2% cut as conservative margin. So that is how the 5% is derived. Now another is CRR. So can't lend it because it is kept interest free with the RBI, but can liquidate on any future issue. So this doesn't 4.5%, like out of 100 crore, 4.5 crore doesn't give any return at all. So on daily basis for meeting this deposit withdrawal needs, this is mainly RBI's cash in the form of currency chest reserve. So this is what RBI prints out and gives to us as currency. So that's like 4.5% of the deposits from the depositors. Then the PCR ratio, say it is 70%, and the CASA ratio, let us assume that as 45% for a particular bank. So if you see, we already spoke about PCR. So PCR is nothing but the total provisions divided by the gross NPA. We have assumed the gross NPA here for this particular bank, which we are discussing, as 1.2%. 1.2% means 1.2% of the total deposits has been identified as gross NPA. Now SLR we discussed, HQLA we discussed, CRR we discussed, which doesn't fetch any returns for the bank. Now the total deposits is been derived after deducting the SLR, HQLA, and the CRR provisions. Here, in fact, it is deducting both. I will correct it here. So it is both SLR, then HQLA, then CRR, and the provisions. So that's how it is. So all these things has been deducted from the 100 crore here. So from 100 crore, which is the total deposits, we have deducted SLR, CRR, HQLA, provisions. Then we got the total deposits which can be lended out by the banker. We have got savings account, current account, fixed deposit, recurring deposit, and other things as well, out of which current account has got zero interest to be paid out by the bank. So the cost of liability, if you see, it's simply zero. Rest all has got small, like savings has got 3%, then fixed deposit, recurrent deposit has got 7.5%. So accordingly, this is the amount which has to be paid out by the bank to the depositors. So the total cost of liability is 2.47 crore, which is paid out in the terms of interest rate payoff. Then now coming to the total deposits is 100 crore. The provisions is being found out as 1.714 crore from this equation, which is the total provisions by gross NPA. So to get the total provisions, we can multiply 70% PCR ratio, which is 70, into the gross NPA, which is again 1.2% here, and multiply it with the total deposits. Then we will get this value of provisions. Then the deposits is there, SLR is there, HQLA, CRR, everything deducting, you already got the amount which is available for lending. Then let us consider a lending rate of, say, 8.7%. So 8.7% lending rate, in the sense you have got lot of things. Commercial loans, then home loan, then personal loan, education loan, many things. But out of which, if you see, I'm taking 8.7 as an average value. It cannot be done like this. You have to consider each and every interest rate and the account and then derive the value. But for discussion purpose, for your understanding purpose, simplicity purpose, I have considered an average total lending rate as 8.7% for the bank. So if you see HDFC Bank, taking the case of HDFC Bank, it is having non-corporate, like they are giving more to retail borrowers. So in that case, you have got a granular scheme which we have already discussed earlier. Granular loans leads to lesser NPA and higher interest rates also, because if you are lending to corporate, you get a you need to negotiate the terms with big people, like say you are lending to Reliance. So Reliance will have its own terms because it is borrowing a huge amount. The volume is very high, so they will expect some leniency in the interest rate, lower interest rate, and some terms and conditions for the payoff as well, which is not available for we retail investors, wherein we maximum take a loan of say 60 lakhs, 70 lakhs, or maximum 80 lakhs or something like that. So that's how it is. And the interest income, if you see directly, we have taken it from various interest. So SLR as HQLA has got various interest rate which is mentioned above, and CRR doesn't have any interest rate which is to be given to the bank, so it doesn't fetch any interest rate, so that is why it is not considered. Then the total 71.3 lakhs which is available has got a 8.7% interest rate, because they are lending to various borrowers. So that return total is 7.33 is the interest income, out of which the net interest income will be interest income minus the cost of liability. So 7.33 minus 2.47 will fetch you 4.86. So the net interest margin will be nothing but the total uh, net interest income divided by the interest bearing assets. So it will be uh, the equation works out to be 5.18%, which is the net interest margin. Other income, if you see, I have considered the investments. So bank has got investments. I have considered a return on investment of around 8%. So considering 50 crore investments accumulated over a period of time, so it is fetching around 4 crore. So total is like 4.86 plus 4 crore is fetching you 8.86, which will be the total income for the bank. Now bank has got various, if you go into detail, expenses they have got expenses like management charges, marketing charges. So all these things you can understand from the detailed balance sheet of the bank, wherein you will get the total breakup of P&L statement, cash flow statement, all these things you can analyze. This Excel I had mentioned just for you to understand the various parameters like repo rate, gross NPA, PCR ratio, CASA ratio, various interest rates related to savings, fixed, recurring, current, then what is SLR, HQLA, CRR, all for understanding all these things. Then the net interest margin, net interest income. For understanding this only, I had taken this example. So hope this session was useful for you. I will come up with another video, which is session number 98, wherein I will be analyzing various stocks like HDFC Bank, other banks like your Federal Bank, South Indian Bank, ICICI Bank, Axis Bank. So all the parameters which we have discussed in this session will be discussed in detail there with real case example. I have tabulated the data of various companies which has got, I have spent a lot of time on that. So for consolidating or accumulating or collecting all the data of various companies, whatever we have analyzed here, all these parameters of various companies has been brought together, and I have tried to project it to you in a detailed way so that you are thorough on the analysis. So I'm trying to put my best to deliver the best to you so that you learn from the efforts we are putting. As a token of appreciation, I request you to give me a like for this video if you think this is worth seeing and have added some value to you. Don't forget to subscribe. Keep supporting. See you in next video. Till then, happy investing.